Hey everyone, and welcome back to another video for today. So in the previous one, we talked about 4 companies worthy of maybe picking up before they report their quarterly figures. In this one, let's focus on the other side of things. Companies where I feel it might be worth waiting until after the earnings report and after the earnings call. Why is that? Maybe some of these companies have run up quite a lot leading to this earnings report. So maybe everything's priced in, which means that even if it is a good report, stock might not move or might even go on the downside. Now, it's important to know that these are still good companies. These are not companies worthy of cutting from your portfolio. As we've discussed in the other videos, these are the companies that will report in the upcoming week and weeks. So of course, the upcoming week is quite a hectic one, right? SoFi, PayPal, Meta, Microsoft, Alphabet, Apple, Amazon, Reddit, Eli Lilly, Cloudflare are all reporting over the next couple of days. Then the week after that, we've got AMD, Arista Network, Uber, Pfizer, Spotify, Root, Qualcomm, Robinhood, and the list goes on and on and on. Earnings season is really about to kick off at 200 miles per hour. This is basically what's going to happen next week. I'll try and cover as many companies as I can next week. I will not be home. I'll actually be in Los Angeles. I'll explain maybe over the next couple of days. And so in today's video, let's talk about some of the high-flying names, the CrowdStrike, the ARM, AMD, Rocket Lab, and yes, I'll even touch a little bit on Palantir. So if you're interested in all of that, hit all the buttons. Really appreciate that. Fun support me even further. Do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to full.com/couchinvestor. Thank you very much. And of course, a special thanks to Fiscal.ai, previously FinChat, for sponsoring this video. Especially in the earnings season, I do find that this is the best stock research platform to use. I'll explain throughout the video why. There is a link in the description and in the pinned comment. You'll get 15% off. New users will get Fiscal Pro for free for the next 2 weeks. And of course, thank you to everyone that has been using my link. Hopefully you're enjoying it. So company number 1 here is CrowdStrike. CrowdStrike, one of the best names out there when we talk about cybersecurity, but also one of the more expensive ones. Remember, CrowdStrike crashed last year because of that outage, worldwide outage. The stock crashed, and even when it crashed, it wasn't that cheap. That's the thing with these types of companies, as we've discussed 3 months ago. Certain companies will never be cheap. They'll just be less expensive. That's something that you need to understand as an investor. A lot of quality companies will never be super cheap. They'll just be less expensive. CrowdStrike here, prime example. CrowdStrike, all-time highs right now, $132 billion in market cap, forward PE 124 times, price earnings to growth ratio 68. So yeah, it is very, very expensive, but it is a high quality business. Now, why has the stock soared to all-time highs more recently? Well, it was something they mentioned during the Falcon 2025 event mid-September. This is also something that you can find on Fiscal.ai. You go to the transcript right here, and then you click on the AI summary, and it will give you all of the important numbers. Now, the big number that they gave is for guidance. So they anticipate over 20% year-over-year net new ARR growth for fiscal 2027. The company projects a non-GAAP operating margin of 24% or more for fiscal 2027 and a free cash flow margin exceeding 30% also for fiscal 2027. Then looking further ahead, CrowdStrike has set an ambitious new target of $20 billion ending ARR by, here it is, fiscal 2036. So yes, a long way to go. Now, the previous guidance that they gave us was, I believe, for 2030, and that was $10 billion. And so that $20 billion by fiscal 2036 is, well, has been viewed as a huge growth catalyst for this stock. I mean, it's 11 years from right now, so, or 10 years, fiscal year talking here. That's a long way to go. Now, if we look at CrowdStrike right now and what the market expects it to do over the next coming fiscal years, it's still expected to grow above 20% revenue-wise. Free cash flow for this fiscal year is only going to be 5.9% year-over-year growth, and then 48.6% in fiscal 27 and another 30.1% in fiscal 2028. As for gross profit margin and free cash flow margin, gross profit margin has been around the same, right? 75% or so. Free cash flow margin more recently, of course, has come down on the last 12 months basis, but that's because, well, they've taken a hit here Q3, Q4 of fiscal 2024. It would probably surprise some of you that if we look at operating margin over the last 12 months, it's still negative. It's negative 6.2%. Only in Q2 2024 was it 1.5%. 1.5% operating margin for the last 12 months back Q2 2024. So again, tremendous company, but very, very expensive. If we look at annual recurring revenue, growth rates are coming down, of course, but still above 20%. And so with CrowdStrike, they're expected to report at the end of November. So we still have a long, long way to go. But with CrowdStrike right now at these prices, I think it's way better to just wait and hear them out. Moving on to the next one, and that's Rocket Lab, a company I've been covering for a long, long time, a company that I've owned for a long, long time as well. Rocket Lab is one of those companies where I'm saying right now, look, I have a position, and those that don't have a position, maybe it's worth waiting for the earnings report, and especially the comments that will be made during the earnings call, because a lot of future growth is, in my opinion, priced in right now. It's a $31 billion company. Revenue of the last 12 months is around $500 million, yet it's still expected to grow quite rapidly, still unprofitable, right? It's one of those companies that very, very unprofitable at the moment. They're ramping up or trying to ramp up Neutron, right? We're waiting for that first Neutron launch. And that's the thing. Neutron was an expensive program. But once Neutron starts flying, once Neutron starts generating revenue for the company, well, things will change quite rapidly. But that's the thing. Only once that happens. In the meantime, yes, Electron, space systems are, of course, helping the company. But Neutron changes the game here. And if there is any indication that Neutron is delayed, I do think that we're going to have an opportunity to buy more shares of Rocket Lab at way less than $64 a piece. Now, if we're looking at Rocket Lab right now, like I said, it's a company that's still expected to grow quite rapidly over the next coming years. Free cash flow margin, non-existent right now. Gross profit margin has been improving over the last couple of quarters. So that's definitely something, well, good to see. If we look at operating margin here, of course, as I told you, there's no point in looking at that at the moment. Of course, once we've reached a point of maturity, especially for Neutron, this and the space system, satellites, you name it, this should, of course, trend to the more profitable side of things. Looking at the business itself, some people still think that this is a pure launch business, but no, launch is still much smaller than space systems. But of course, once Neutron gets up and running, things get very, very interesting here for Rocket Lab. Looking at a backlog, we see here space systems and launch services. Space systems did take here a bigger chunk of the backlog pie, but it is also important to note that in the backlog right now, I believe there are 3 Neutron missions that are included in that. More recently, we've had a lot of new contracts, right, for Electron, so that's definitely a good thing. Looking at the charts right now, we can see that the stock, of course, previously back in late September, stock did very, very well to rebound on that 50-day moving average. Now, to go back to that 50-day moving average, let's say they do say, look, Neutron, we're not 100% ready yet, and so we are willing to delay the launch. Then a drop of around 17%, if it were to happen over the next couple of days, would bring us back to the 50-day moving average. I would invite such pullbacks because, like I said in the other videos 3 months ago, I said, look, if they think that they don't feel like they need to rush to launch Neutron just for the sake of meeting a deadline, but they know deep down that it's not going to be a successful launch, then just delay it. Delay it by a couple of weeks, maybe a month. I'd rather see Neutron be successful first try than see it, meet a stupid deadline, but explode a second after it lifts off. I hope that's clear. Moving on to Palantir. It will be a quick one because I do want to touch on the other two a bit more. So Palantir, incredible company, incredible margins as well. Some people are saying, look, if Palantir can be worth $438 billion with around $4 billion in revenue for the year, then this company should also be worth XYZ billions of dollars. But that's not usually how comparisons work, because you have to understand that some companies are capex heavy, some companies have low gross profit margin, operating margin, free cash flow margin. Palantir, in this case, yes, I think we can all agree that Palantir is extremely expensive, which is why it's popping up in this video yet again, because I don't think it's worth chasing until we continue to see the company accelerate revenue, grow faster, and actually also expand margins. This is something that they've successfully been doing over the past couple of quarters, which is why it has gotten an insane premium from the market. But still, when you look at this company right now, incredible margins and all of that, but $4 billion in revenue, $438 billion in market cap, yes, I do think that a lot is priced in. Now, I know some people say, oh, but you don't follow the company anymore because you don't own it. I do follow the company. I follow it quite closely. Last quarter, I tweeted out before they reported, this is probably going to be the first $1 billion in revenue quarter. This was what Wall Street was looking at, and this is what Palantir guided for. And guess what? Revenue came in just above $1 billion. Guess what's expected to happen for this quarter? Revenue coming in just under $1.1 billion. Will not be surprising to me if they also beat their own guidance right here, and of course update the full year revenue guidance. This is again a tremendous company, a company with, of course, insane margins, especially free cash flow margins. Gross profit margins have been around 80% for quite a while. But this is again, the special thing here about Palantir is that it is reaccelerating and accelerating growth while also expanding margins. Usually what happens is you accelerate growth, but margins do not expand at the same time. This is not what we've seen with Palantir. We've seen this also with operating margin. That's all and well, right? We know that the business is doing excellent right now, but there is always a correct price to pay for it. I don't think that plus $400 billion in market cap is worthy of a chase. Moving on to another company, again, great companies, but in this case also not worth the chase unless the company proves me wrong. ARM. ARM, of course, incredible company. Well, gross profit margin, in the high 90s%. But when you look at the company, when you look at ARM, the whole industry, you would have expected the company and the business to have accelerated already, right? This is a company worth $180 billion, revenue also around $4 billion over the last 12 months. Margin-wise, great company. But with great stock performance comes great responsibility, right? This is what Uncle Ben has told us time and time again in every Spider-Man reboot. In ARM's case, revenue-wise, still expected to grow 20% over the next 2 fiscal years, fiscal 27, fiscal 28. They are already in fiscal 26, and here revenue is expected to grow by about 17% or so. So again, not the fastest growing company, but definitely a growing company. What we have also seen is, of course, gross profit margin, still the same, high 90s%. Free cash flow margin over the last 12 months, last quarter, 16.4%. Now, this is a business that makes money through royalties and licensing, right? It's almost a 50-50 split right here. As you can see, last quarter, that only grew 12.1%. If we then have a look at operating margin, yes, of course, it has done very well since the Q4 2023 quarter, where back then, last 12 months, 1.4% were not 18.5%, definitely much better. But then if you look at the last 2 things here, annualized contract value, last quarter, we did see it increase quite nicely, so that's great. This has been increasing for the last couple of quarters, so that's great. But remaining performance obligations, what we've seen with a lot of other companies, right? We've seen their remaining performance obligations, or RPO, go up because of this whole AI race, because of this whole data center build out. ARM being quite a important component, right? Important company in this whole ecosystem. I'm yet to see the huge increase here in revenue in RPO. Actually, RPO has declined since the first big jump, September quarter of 2023. Again, you would have expected a company like ARM, since ARM is in a lot of headlines, right, with a lot of these Stargate projects, SoftBank, you name it. but we're not seeing it just yet, which is also why I'm putting this in this video, because again, I don't think it is worth chasing. You're paying a high premium in this case because it is a good company, but I don't think it's worth chasing. Moving on to the last one, AMD. Quite bullish on AMD. I own a lot of AMD. AMD is now worth $410 billion, $254 per share after hours on Friday. Of course, the stock more recently has gone up quite a lot because of, well, fundamentally things changing with the company. That OpenAI agreement, we've heard from Oracle as well that they are a huge customer of the company, huge customer of the MI400 series. So for good reasons, it has gone up. But here, me as a shareholder, I am willing to wait and see what gets mentioned in the upcoming earnings report, and especially call, because right now we can maybe get a lot more answers from Lisa Su because those deals have been announced. Previously, it was always, we expect to generate tens of billions of dollars. The total addressable market of the AI accelerator market is $500 billion, and maybe I'm too conservative, etc., etc. But now maybe we might be getting actual numbers. I've seen some people already throw out, AMD is a $1 trillion company. Yeah, maybe in the future, but definitely not today. Definitely not today. Today, if we look at the expected growth for AMD, that's 28% growth for this fiscal year, then 21.4% in fiscal 26 and 16.9% in fiscal 27. I do fully expect these numbers to be revised on the upside, that's for sure. Looking at gross profit margin and free cash flow margin, we've seen those, of course, go up and to the right, especially since the bottom right here, Q4 2023. Last quarter did have that China impact, so that impacted here a gross profit margin. Same with operating margin for the business. But all in all, by the way, previously, I think at the start of the year or so, the free cash flow expected number for fiscal 27 was about $1 billion lower than where the number is at right now, which is at $10.3 billion. So yes, I do think that we are going to get revisions on the way up. The same with EPS. I believe AMD, before the OpenAI deal, was trading at around 20 times 2027 earnings. I think that will be revised on the upside, but of course the stock has gone up as well. We've also had Intel. Intel just reported, right, its quarterly figures, and Intel reported quite okay figures, right? For the client side of things, the data center AI side of things was okay, but the client side of things could give us a lot of positive indicators for AMD's upcoming quarter. I will have a specific AMD earnings preview video probably out on Monday. But yeah, AMD, great stock to own. I just don't think it's worth chasing right now going into the earnings report. Purely looking here at the stock, do I think we can go back to the sub $200 levels? That would be quite an astonishing crash. Plus again, this move right here, this is like the move that we've seen with Nebius after the Microsoft deal. Again, it's a move that fundamentally changes the way you're looking here at this company. So no, I don't think we're going to go back sub $200 level. And if we do, it's probably going to be because of macro specific things. But with AMD, again, also right now we are overbought. With AMD, I don't think it's worth chasing. I think it's just worth waiting, listening, looking at the results, listening to what Lisa Su and the team have to say during the earnings call, and then we'll make our decisions moving forward. And so all in all, that's about it for me in this video. Of course, we could have talked a lot more in this video about other companies. Same with the other videos. We could have covered way more companies out there. Do let me know down in the comment section below which companies you are buying before the earnings, or which companies you're maybe trimming, cutting before their earnings report. And again, if you feel that you're light on cash going into an earnings report on earnings season, don't be afraid to raise cash. Yes, maybe some of your names in your portfolio, again, you like them, but maybe they are a bit overextended. If you really want to feel more comfortable, nobody got poor by taking profits. Just remember that. Anyways, that's all I've got for you in this video. Do check out fiscal.ai down in the description and in the pinned comment, and we'll see each other in the next one. Bye-bye.